want you guys to give a big hand for Will Morris. He's going to show you guys how to start your own fund.
All right. Thanks, Chris, for having me. Guys, I didn't really prepare a whole lot for this. Chris wanted me to kind of show. Chris wanted me to really talk more about what I've done and really get how to cater to what you guys have done or what you're doing. And so, private equity. We've all heard about the private equity hedge funds. It's all mystical, Wall Street, big time money, right? And I heard the same thing. I'm sure you guys heard all the same thing. And let me, before I start, I'm not an SEC attorney. All this stuff is not legal advice. Do not take my opinion. Do not do anything you say. If you invest, you may lose money. You may not take. So we've all heard that, right? I have to say it. We all have said it. That's anything that has that. People is automatically like, man, that's mystical. I don't know about it. I don't know if I want to be involved in this. And so you think, well, that's for the big boys. That's the people that can write the $40,000 PPM checks. That's the people that can hire the best attorneys, the best of Wall Street brokers and security guys. But the fact is that, in my experience, as me doing it, is that it's just totally opposite. I was quoted, what I'm going to show you here, I was quoted $40,000 to do exactly what I did for literally about $800. And I'm not saying that you can do it. Again, we got to throw out those disclaimers. It's just the nature of the beast, right? But the thing is you do have to understand a lot. You have to understand a lot of liabilities. You have to really know it. I mean, you basically have to become an SEC attorney to understand a lot of this shit. But on top of that, what I come to find out is that my PPM operating agreement, subscription agreement is an 80-page document with number 10 type text, right? Because I wrote every bit of it, every word, every page. I typed it, I texted it all out, I studied everything. And by doing that, what I found out is that in reality, about 95% of your PPMs and all that stuff is really the same thing. There's only a few pieces that you need to really know what you're doing and know how to structure. And what that boils down to is basically what you're doing, what you're investing, how you're raising capital, how you're going to make your returns, how you're going to pay out your investors. They're called distributions. And that's really the nuts and bolts of it, which we all talk about. I've been listening to you guys all weekend, and what the things that you guys do is the exact same things these billionaire hedge fund owners do to an extent, as far as structuring deals, finding deals, knowing how to estimate returns, knowing what kind of mobile homes. I mean, Chris is freaking killing it. If he was on Wall Street, he'd be one of the most successful guys on Wall Street right now, probably raising capital for what he's doing. But he's in the trenches actually doing it, and I admire him for that.
He would hate Wall Street.
He would punch
every one of them in the face.
Exactly, because it's a different mindset. But what he's doing is would he not be successful? In what he's doing. So, I guess a few things just to give you some. I don't want to bore you too much with sort of the standard stuff, but one thing that you're going to really have that you have to understand is called a PPM, and that stands for a private placement memorandum. And basically, that's literally the 40 to 80 page document. That's 95%. It literally says that investing is risky and you might lose everything. No returns are guaranteed, like in 37 different ways. I think there's even some Spanish in there. So I mean, it's amazing how. To me, it's amazing how such a big, important document. I mean, it's like buying a house or a closing. I mean, you got a stack of papers this big when you buy a house or something. Nobody reads all that stuff. And if you really did, you probably wouldn't buy the house. I mean, a proper PPM. If you're an investor and you read a proper PPM, you would never invest in it, because it basically tells you that you truly have an option. There's a good chance you're going to lose your money. But investing, we all have a good chance of losing our money. We don't know if COVID's going to hit or a hurricane's going to destroy all the property we just bought. So PPM, that is the money, the gray area. So if you talk to an SEC attorney, and I don't know if any of you ever pursued this or ever heard it, this is what I was quoted, $40,000. He quoted me $40,000 to do that. And what that is, I said, well, why is it $40,000? I don't understand. Why is it so expensive? She said, well, we got to talk. We've got to figure out what you're doing, how you're doing it, how you're structuring it, how can we give it back to the investor, how can we make sure this, how can we do that? I was like, well, I know all that. I know what I want to do. I know I want to, I want to buy multifamily. I know I want to, the standard rates of returns out there, like a 6 prep, and then we can do 70-30 splits. I'll get into that in just a second. So, when you kind of understand it and know what you're doing, it's like, well, why am I paying you $40,000? And so I kept pressuring, and this lady, she's good as gold. One of these days I will pay her much more than $40,000 for as much she's helped me out. And so she was a referral, she was a friend of mine, or a friend of a friend type of deal. And I finally asked her, I said, you know what? I'm kind of, cocky, I guess. I said, I feel like I know a majority of what I need to know. I said, how much is your hourly rate? She's like, oh, well, I charge $400 an hour. And I was like, okay. I said, well, what if I was to just call you every time I had a question? You give me an hour of your time for $400, you're an SEC attorney. And so what I did is I went out and I took 8 different PPMs, anything from a 40-page to literally 140-page. I read every word of them. I understood them. I seen the similarities in them. I seen the differences in them. It helped me structure, it helped me kind of in my mind see the structure of the deals. And then I went back to her with the questions. I took all the similarities and the things that I seen that were literally about the same. The warning you could lose your money pieces basically. And I said, look, okay, I've got all that. Now, what about this? And so I took the $40,000 and I literally narrowed it down into $400 hour increments of me talking about just the nuts and the bolts. Just the why would I structure it this way versus this way? What is this? What is that? The real meaning of what you would actually hire somebody for. And so through doing that, I was able to literally save
A lot
I don't know, a lot of money.
$39,000.
Yeah, so, because I called her a couple times, but you get a lot of questions out in an hour, and like, it wasn't, hey Will, how you doing? I was like, hey look, I got you for an hour, I need this, now. I was like, I'm paying you $400 an hour, don't waste my time. And so, I got that squared away. The next thing, which is kind of, again, they're kind of some templates, I'm not going to say templates, but you see a lot of similarities. So your first piece is called a PPM. Your second piece is going to be I'm just going to abbreviate here, subscription agreement. Okay, and then what a subscription agreement is part of your, it becomes part of your PPM. This is basically saying, hey look, we have read and understand your PPM. We're agreeing to everything that you're saying. We agree to your terms. We agree to your distributions. We agree to whatever you're doing, however you're doing it, all the terms. We're agreeing to it. And then in addition to that, it has, if you are, and I'm going to get into this in a second, accredited versus non-accredited, it has your information as far as an investor, your investor bio, bank accounts, all that good stuff in there. And then the third piece is no different than an LLC, is your operating agreement. Again, the operating agreement, when we set these things up, is you really want to set these up very specific. Each one is an entity. Each one of these is an LLC. And again, I'll get into this in just a second, the structure of how I did mine. But your operating agreement, again, is really going to it kind of overlaps a little bit of the PPM. It really says like, hey, look, we're looking for Class B, Class C assets. We're looking in the South, throughout the Southeast. We're going to be, targeting, value add opportunities, just how it's going to outline like your distributions again. And so when they sign the subscription agreement, they're agreeing to everything you put together. Now, I guess let me segue into the beauty of doing this. And this sounds, I don't
mean to interrupt you. Can you touch on the piece about how you got the relationship between you and the guy named Cal?
Oh, Cal. Okay, so Cal.
Because it gives you a massive credibility. It gives you massive.
Okay, so I partnered up with a guy named Cal, and he don't like me in the front guy, so I'm gonna get too much on his background. But he actually started and launched Cardone Capital for Grant Cardone, and I partnered up with him, and he's the one that really taught me a lot about this as well. So having mentors again is a huge part of this. He showed me how they set his up. He showed me how when he left Grant, he went on to work for 3 or 4 other family offices and growing them, and he did sort of the same thing as them as a chief acquisition. So he really understands this stuff. He's got like 13 degrees or something. I mean, he's really that kind of guy. And so a lot of this again is learning from him and that SEC attorney. But so I guess let me dig into how I got mine structured real quick, and then I really want to sort of, I don't want to get too technical on the structure, but as much as I want you guys to sort of take the blinders off, because really I was telling Chris when I learned this and I did this is really like the biggest thing in the past couple of years. It's really like a big aha moment. You know, your blinders come off. You really can afford anything. You know, when money's not an object. So basically, mine is a private equity. So I'm just gonna put PE for example. It's a private equity fund, and it's $10 million, and that will equal me about $30 million in I'm gonna put ACQ acquisitions. And so equity, whenever we buy a deal, you're talking about 20% down on mobile home parks, you know, houses, whatever. In my world, that's called equity. And so the 10 million is basically my 30% down. And so that's what I focus on. This is to get to 30, the other 70% is what I call leverage, which you guys know all about this. So leverage, debt, whatever you want to call it. And so whenever I'm looking at deals, I really forget about the individual deal as much as like the overall acquisition cost, you know, the $30 million. What I'm looking at is how much equity is it going to take. You guys riding up down this street looking at these houses and different things, I'm looking at that big boy down there with the big archway. I'm thinking, man, how much equity is that going to take? How hard is that going to be to raise? Because I, you know, the acquisition's irrelevant as much as it is to me because I'm the fund manager, right? I'm the fund manager, so I'm worried about how hard is the equity going to be to raise so that I can deploy into, and just like you said, and I couldn't agree more, if you get the great deal, then a lot of times your debt, your sponsors, all that, the other pieces will fall into place. And so I'm looking at the equity piece. And here's the reason why I'm looking at the equity. And I don't want to, you know, I apologize to all the equity funds out there for telling their secret, but the beauty of this is that you start getting paid two ways. We'll go into that too. And if I'm rambling, you guys just hit me with questions.
Good, that's real good.
So the big aha moment was one that I can buy anything as long as I can raise capital, right? It eliminates your, you know, he's talking about, hey, I'll partner up with you, but you got to bring 100 grand. And when he said that, I was like, man, I got to come out 100 grand in my pocket. But then the other thing, I'm like, I know 3 or 4 guys who got 100 grand. Like I can get them to come in and I can arbitrage that. So what this does is there's really 2 ways you get paid in a fund. So like here's my $10 million. And I'm just going to use the example because it's fresh. So my $10 million fund, in this PPM, when you're writing all this out, you're going to be putting in there that you get 120K a year as sort of it's not really called a salary, but that's really technically all you're showing is getting paid from the fund. You're going to get $1 million in working capital. And so out of $10 million, I can actually spend up to $1 million if I need to for travel, marketing, legal, whatever I need to. I'm going to get a 1%, what they call acquisition fee. You know about this, and this is based off of, remember, this is $30 million. Oh shit, that's $1 million percent. So this is $30 million. So even though my fund's $10 million, it equals $30 million, right? And so I'm getting 1% of this $30 million. This is the fund. So this is the fund paying me as a manager. You know what I'm saying? Like this has nothing to do with real estate yet, other than the fact that I'm raising money and I get paid to spend other people's money and to manage it. And you know, you got to be ethical. I'm not saying go out and do a bunch of stupid stuff, but anyway, 1% fee of that. So I get 300K the day I spend $10 million. I get 1% annual. It's called an asset. I'm trying to abbreviate here. It's asset management fee, and that's 300K yearly. That's per year. Disposition, which is sale, I get 1% disposition. And so when we sell, I get another 300K. Okay, so 300K. And so this is what I'm making off of raising $10 million and basically just spending it, right? Well, then the other kicker, this one down here, is I still get, because my funds, I set it up as a 70-30 split. All right, and what that means is that I raise $10 million, which is my investors. They are the 70% in my fund, in my deal. They are called LPs, as in limited partners, okay? Me, I'm this piece right here. I'm 30%, I'm called a GP, general partner. That's sort of the owner. And so my 30% over here is I still own 30% of the deal as well. So in multifamily, mobile homes, you still get cash flow. So you're getting this equals cash flow, like Chris talks about. So I'm getting paid by the fund, my fees or whatever. And this is kind of low. It's kind of, I'm not gonna say, I've seen a lot harsher fees, I'll be honest with you. So especially mobile home park, man, the funds that are in mobile home parks are killing it right now. And so basically I'm getting paid by the fund is paying me, and then in addition to that, I'm getting 30% of ownership in the deal and cash flow. So now, go ahead. You got a question?
No, it's good.
Do I need?
But the fund is paying you if that 10 million is working in a deal.
You got to keep it deployed. That's exactly right. But I'll be honest with you, man. Deals are not hard to find right now. I've got more deals than I mean. I could literally deploy almost $50 million right now if I get it allocated. So
what's the 10 million to the 30 million? So if you raise 10 million, you can get 30. Where does the 30 million,
So,
20 million come into
the
play?
down payment is, I call it equity in the world. It's called equity, but think of it as your down payment. Just like when you go to the bank and on the mobile home or the house, whatever, like, hey, we need 20% down, 30% down, whatever. That's what it is. That's all we're looking to do is we're using other people's money to raise that. And so let's talk about raising that. 10 million bucks. When you set one of these things up, what I like about it does two things. Is we're all thinking about going out and finding deals, right? Like I'm gonna go out and I gotta find this deal, find that deal. Well, the other benefit of it, and I'll be honest with everybody, I'm not the best operator. I'm not. There's guys out there that are phenomenal, great, more operators than I am. Thousands and thousands, tens of thousands of units, right? Well, who's to say that they can't find great deals as well? They probably got better deals. They probably got existing relationships that are getting that deals that I can't get. Multifamily is very competitive, right? So you got to leverage as much as you can. And if Chris over here is getting 10 times a better deal because his 12 years in a relationship and 5,000 units, how am I going to compete with that, right? So a fund, think of it as a vehicle that allows you to do. Let's do our little car here. It's a vehicle, and we'll put PE on it. So that's my car, and what this vehicle is going to allow me to do is a couple of things. One is we can do our own deals, right? So our own deals, like we're all already doing, we can fund our own deals. The second thing that I want to talk about is you can do other people's deals. And what this is called a fund to funds. Okay? And so if you're doing a fund to funds, what that means is that, say you've got a deal, your apartment deal, your land deal, we've been speaking about land deals, his mobile home park deal. He's got 4 right now. What did I ask you the other day when you said you got 4? I said, how much equity is it? How much we need? He's like, man, maybe $4 million bucks. All right? I'm thinking about that because what I can do is if I can raise the equity for that, I don't have to own it. I don't have to necessarily own it, operate it, don't have to deal with it or nothing. But I got some guys out there that give me 50% of the general partnership just by raising that $4 million bucks. So I take the $4 million, I park it into his $17 million roughly worth of real estate, and say, I'm like, look, man, I'll do that. I want 30% of the GP, 40% of the GP, or whatever. So now my equity is being paid by the deal's paying my LPs. Remember, my investors. You always got to take care of your investors. They're kind of the baggage. You know what I'm saying? Like you're pulling them along. You're the horse and they're the cart. And so, or maybe they're the horse and I'm the cart. Anyway, the deal's taking care of them, right? And then I'm going in it and saying, look, I still want 30%. So now I can get 30% of his deal, and I don't have to touch it. I don't have to own it. I don't have to operate it. I don't have to do nothing with it. I got to make sure my investors are taken care of, but I get 30% of the deal. So over here, I'm getting 30% as a GP. Over here, I'm getting 30% as a GP. This is his deal, Chris's deal, not my deal. That's my deal. And then on top of that, the fund's still paying me because I'm still spending money. So I'm still getting paid by the fund. So that's 2 ways. So, you could do, I'll put over here, put the fund. So that's number 1. Number 1, the fund's going to pay you there. Number 2, you get actually in the deal, you get paid, multiple streams of income by doing the same exact deals. The other thing you can do over here kind of ties into like what Chris was talking about, and he might correct me on this because I'm still a little gray on it, but this is a vehicle, it's a legal vehicle, it's approved through the SEC, everything's legit, and so you can actually take in Is this not correct? Taking IRAs and stuff? Can you not roll those into funds? Exactly.
My
Now,
4 funds are almost all self-directed IRA funded.
there you go. So now you can do IRAs. You can talk to Chris and be like, hey man, I like what I'm doing. I want to set up a fund. I want to do this. And I want to roll people right into my, you know, and think about, I think the timing's impeccable on this too, because Chris, they're talking about the baby boomers and all stuff. If you do your homework and understand the baby boomers and like the conditions that a lot of them are leveraging the stock markets and you know, they're getting their asses handed to them a lot of times. You know, it's come up from where it was, but you know, they could get out, you know, and get into real hard assets here through your fund. And so this is another avenue for making money. Am I still with you? You still with me?
Well, just make sure they know that it can't be a regular IRA, it's gotta be a self-directed IRA.
Self-directed, yeah, that's
You
right.
can't move a
Can
regular
you do a
IRA.
self-directed 401k too?
Oh, sure, solo case, absolutely.
Yes, sir.
So in option number 2, how much ownership does the fund or the investors have if you have 30?
The deal's gonna pay the investor. So like on option number 2 here, this is negotiable. So like I'm gonna go to Chris, you know, he asked me the other day, he said, how much would you typically take? And I was like, man, I want it all. I want it all, but in reality, you know, you're gonna be in, you know, because he's gonna come back up, now I'm gonna pay 10%. So now you're negotiating. And so what you're negotiating here is your GP.
5%.
So you're negotiating your piece, your general partner piece.
But to answer your question, like the fund money is actually getting paid by the LP side of Chris's deal, so that's taken care of.
Right.
Because they're actually getting the LP side.
Yeah, my job is to make sure I do great deals. As long as I'm doing great deals, then, and I do everything I can to make a good deal great, like I import stuff, I think I told you a few of them. If I need to turn a good deal great, then I'll say, look, I'll import and I'll get you cabinets for $30. You know what I'm saying? So like we can do what we need to do. That's sort of my little value add. Why invest with me versus somebody else. But you know, as long as I'm doing good deals, the deal takes care of the investors. They're invested in the real estate. What I'm invested in it as well as a partner, as a GP. And so, let's see, I'm trying to think what else we could do. Any confusion, any direction you want me to go? Because I could probably talk on this for a day, but.
When you say the 10 million on the down payment, right? When you say raising the equity, you're getting financing the rest of it somewhere at a conventional bank that you already have set up, or they're a part of the fund, or
No, it's just
you just
normal-
use your
normal
resources.
lending. Normal lending on the
Right,
debt.
okay.
So the debt's gonna, the debt's gonna just, yeah, I mean, it's normal debt.
Right, no, I got you.
It's leverage. 10 million allows you to buy 30 million worth of real estate because you're leveraging the 20 million, the other 20 from the bank.
That-
But you still have to have people that have the network to cover the loan, right?
Right.
So that's why
Still
there
gotta get
is a
some sponsors and
30%.
stuff. Well, let's talk about that.
GP.
Okay, so let's talk about it. So say I've got, mine's a 70-30 split, and I've had to do this, like, it's very common, and you probably know this as well. So we're talking about the 30%, which is the general partners. Okay, say I'm going in and on this option here, I'm actually gonna have a co-GP. So what's called a co-GP. And so I may split, you know, say he's got 30%, and so now I'm technically only getting 15 because we're co-GP, and we're gonna split 50-50, right? So it'd be 50-50. 15% apiece. Oh, wait, 50%. But anyway, so you've got co-GPs. Say you've got the 30% piece here. Say it's a big deal. Something I've not done before. Something I need a sponsor. Sponsor's a high net worth individual, experience. You know, there's pieces of the puzzle that you got to pull in sometimes. And he's going to say, look, I don't want to. I'll sign on. I'll sign on to you, but I want 15 points or something. You know, he wants 15%. Well, now you're, and it's not direct like that. Look, you would think that's half. It's technically not. It's 30%. So he gets 15% of the 30%, not half. So anyway, so you would have to pay him. So say we've got what is that? 15% of what is that? You know, 4.5%. So
of the total deal.
well, what was it? Let's see. I'm having a mind.
15% of 33.
Yeah, of 30.
That's 4.5.
4.5.
Okay, so that would leave you 20.
3.5.
23.5. So see now, if we're co-GPing, if we had a sponsor, the sponsor would get 15%, and then there'd be 23 or whatever, 0.5, and then we would split that. We each get 50% of that. See what I'm saying? So like, it gets split up sometimes. It's just the way it does. I mean, these big deals is common. I mean, you know, and don't be afraid of it, because the one thing I will say, if you even are going to consider this, what you really need to consider this for, like I was talking to you guys about last night, is this is going to take you from buying one house at a time to buying a whole damn street at a time. Like, you need big deals. You can't do this with one deal. It's just you just need to do a partnership. This does not work for little deals and stuff like this. But what this is going to enable you to do, just like me and him was talking about, you know, instead of going in and developing like 5 lots at a time, we can go in and get 20. You know, get the whole damn neighborhood. You know, help develop the neighborhood. I mean, like it really allows you to scale. Massively, and there's a lot of money in the marketplace right now that's looking for homes like this, is it not? I mean,
There's too much money in this.
too much money. I mean, didn't you say that you had somebody the other day that was you couldn't even get them in one of yours, right? They got it.
I got people lined up to put money in deals, I just can't place it fast enough.
Yeah. And so, trying to think what else. Any more questions?
So talk about the opposite side, so talk about a debt fund,
Yeah,
Oh, what?
a debt fund.
that's what we do, but remember we talked about that?
Yeah, I'm not big on the debt side. I look at private equity and hedge. Now, well, let's talk about that. So why would you have private equity that, in my opinion, Chris could probably correct me on this, but in my opinion, the structure of the deal is really going to dictate what you're doing. So real estate, cash flow in real estate, private equity looks really good because they can own a piece of it, actually own a piece of the deal, and they can you know, get cash flow out of it and progress out. Hedge fund, let's look at that one. Let's put hedges on here. We all want to know about hedge funds. So hedge funds, I was explaining to them yesterday that what they were talking about, so say you're wholesaling, you're flipping or whatever, and you say, and again guys, this don't have to be on a massive scale as far as setting these up. Say you want to start $1 million fund. You need $1 million to be able to wholesale quicker, to be able to flip, have options to wholesale flip, whatever you want to do. And if you're setting up a fund and you say, look, I know you're partnering with me now, a direct investor, well, on like onesie-twosie houses, right? Well, what we've done is we've set up a hedge fund, and we're going in and we're buying 10 houses at a time now instead of onesie-twosies. What they're doing is they're hedging their loss more or less, and they're like, you just come in at a you know, a pref and a split. You know, there's 3 or 4 different ways to set it up that fits your scenario the best. But when they come in and you're going to say, look, we're going to buy these, but there's going to be 3 months, 36 months, or it wouldn't be that long, would it? It would be 3 months. You got 3 months. So 3 to 6 months, whatever you need to, you have to narrow it down. But say you got 6 months from the time we buy to the time we're going to sell. These are our projections. We're projected to buy this in January, or we're projected to sell it in July. And at that time, we're going to give you your returns. And so because of the structure of that, you're not paying out distributions. You know what I'm saying? Like, you got to wait until the end. Like land development, for example, they're hedge funds. A lot of them, because they come in, they buy, they have a holding or a development period, and then once they start performing or selling off or doing whatever they're doing, then they're distributing. Cannabis right now, I've got some I'm looking at with cannabis. It's going to be a hedge fund structure because we got to basically raise the capital. You know, think of this as a pool of capital. This is a pond. This is that pond down there in Rubber Boots in Louisiana, and you're throwing money into it, and it's just kind of sitting there, and then you're going to take that pond and you're going to deploy it into the deal. Hope this is, I'm doing this on the fly, so I hope this is a good analogy. So the pond is all the money's coming in, you're raising it, and then when the deal comes in, boom, you deploy it. You stick it into the deal, and then you do the deal, and then like in the crypto, for example, or I'm sorry, the cannabis, you know, it's going to take a little bit of time to build the facility, set it up, whatever, stuff like that, but then once it starts performing, paying off, and boom, you start paying your investors back. And all that's going to be outlined in your PPMs. And so you really got to know kind of what you're doing. You can't be out here saying, well, I think I'm going to do this, I think I'm going to do that. You need to be very specific. You need to be very specific in what you do. Now that you understand that, you know, it don't necessarily cost $40,000. I mean, it can. It costs hundreds of thousands of dollars to set these things up. But at the same time, when you're thinking about this, there's nothing wrong with doing a $1 million fund. Like, this is our fix and flip. This is our, you know, multifamily. This is our mobile homes. This is going to be our land development. The way I look at it, and the way I have it in my head, is what I'm trying to build, is I'm trying to build little buckets. And this one here might be multifamily. I want to do one mobile homes, especially after watching Chris. So I want to do one mobile homes, and what you do, and so you got one over here for, I know what I hear, single family rentals is kind of doing good. I like industrial. Anybody that's not watching industrial is crazy. And data centers. So look at these as well. And so like I've got these 5 buckets. Somebody comes to me like, Will, I got $5 million. And I go, okay, what's your appetite? How are you feeling? What do you think? It's like, well, I want to do maybe 50-50, risk versus, reward or whatever. It's like, okay, look, I would dump, let's put 2.5 over here multifamily in this bucket. It's safe, low return, but it's good. It's recession proof, whatever you want to say it. And then I was like, you know what? I'm really, really liking the mobile homes. Let's put let's put one over here, one in mobile homes because it's a little higher risk, higher reward, and then let's distribute the rest over here. Now you're giving diversification through a couple of funds. You're kind of playing that fund manager or fund what do we call a securities guy, or their financial advisor. You're kind of doing that, but the difference is that you are actually doing this in your own deals or in other people's deals. You're getting paid from the fund. Remember, the fund is paying you money, and then also the deals are all paying you money too.
And explain how it's different from a syndication. Like, what's the difference between
good
fund and
question.
syndication?
Okay, syndication. Oh Lord. Okay, so a syndication is really the pooling of resources. All right, let me back up. Okay, so a syndication, technically, you still have to do this in a syndication.
Yeah, you're still syndicating.
You're still setting it up. So a syndication is, if I'm not mistaken, is technically called a single-purpose entity or vehicle. I know people change that around anyway. But what this is going to be, it's a good segue on how this is structured to the funds. So you can have what's called a 506B as in board, or a 506C as in Charlie. 506B is accredited.
Non-accredited.
I'm sorry, yeah, no, you can do accredited or up to 35 nons.
Yep.
So you can have accredited, so you can still do your accredited, right? You still get your accredited, but you can also do up to 35. They call them friends and family. Friends and family is a very vague area. So I love everybody, so I guess. So 506B, but the big thing about this, there's no advertising, no marketing. So this is a place to be. Like if you've got some good connections, 506B would be a good one. Set it up. Hey, I've got Chris. He probably, I don't know, he's a pretty good marketer. So 506C is accredited only, but you can market like a madman. You can hire Robert and be like, dude, make me popular. And so this same process happens on a syndication. A syndication, you are going to go out and you're going to find a property. You have a property identified. So you're going to, a syndication is you have a property identified. That's the reason why it's an SPV, a single purpose entity or vehicle or whatever, where part of the world you're from. And so that means that I've identified a property, and then you go out and you try to raise capital. You're basically doing the fund, but it's deal specific. There you go. That's what I was looking for. So it's deal specific, and then that allows you to go out and raise the capital and do all that stuff. And then once you get ready to close, then you still set this up. You probably still hire an attorney and do all this stuff for you. Some of them bring them in house, and you'll find out. Have you ever actually went through the process of one of them?
I've done both of these, yeah.
But have you actually went through them and like, hey, walk me through the SEC.gov and get your anchor codes? And have you ever done that?
No.
You
I
should.
just let the syndication attorney set
You
it
should, because you would wonder why you're paying them anything. Because it's literally it's all online now. It costs $0. You go to SEC.gov. Over on the right side, there's a thing that says information for new filers. You click on it. There's literally two. There's an old packet and a new packet. It's over 900 something pages each. And if you feel like reading, you can read the hell out of it. You can be an SEC attorney to get that. But you go there and you search, and then the rest of it is online application. You go to an EDGAR, you got to request EDGAR access, which means get your EDGAR codes. You literally fill out your name. You gotta have your entity set up, which is another good segue. You gotta have your entities and stuff set up. Once you get them set up, then you literally can just go through there, fill it out. You wait 3 days. It takes 3 days for some reason. You get your codes back, and then you're allowed to access Edgar. You go in there, you fill out what you're doing. You don't even turn in PPMs or nothing. Like it's literally just the structure of what you're doing. I mean, you gotta know what you're doing. You can't go in there and just click around like I did, I guess. Structure. What I did is I set up. I set up Morris Third Capital, and this is if you're watching this, you can go there, and if you're accredited, go there and actually invest at any time. So Morris Third Capital, that is the manager. So this is like the asset manager. And then underneath that, I will have LLC. This is an LLC. This is LLC. And then underneath that, I'll have like I'm just going to do this for you. Morris Fund number 1, whatever, and that does that. And then I can do Morris, and that's an LLC. So see how that's an entity? So this manages these. Morris Fund number 2. And like I said, you guys, I'm not great on a lot of this structure stuff, but this is your manager. These are your actual entities. This company, the purpose of this company is to buy. These are SPEs. These are single purpose entities. This fund this is the fund that buys SPEs. I don't want to get too complicated on this because some of this is more set down top. But basically, this is a fund manager. They manage a fund. This is a fund. This could be another fund. The purpose of this fund is to buy SPEs, which becomes basically a syndication. It becomes another LLC. So there's layers of protection in this and layers of management and everything as well. So, am I losing anybody?
Now I got a question. So, say you got a company like a lot of us in here, right? We want a couple $1 million to go start taking down all our own deals, right? So, was that something you could help us set up if we wanted to?
Absolutely. And what I would look at is and what we would be talking about, just to give it to you here, what we'd be talking about a lot would be like the structure and like how you're planning on paying. When, I mean, because I found out that these investors, they want to know how much, how long, and what's my return. Like,
right.
You know what I'm saying? Like, let's just call it like this. So you got to think about that in the fund, and you say, look, I want $2 million to be able to go out and start, instead of wholesaling, I want to start buying these things, fixing them up, and flipping them, right? You can set this up to raise capital and do that, but you've got to outline it, and you got to make sure they got to understand how they're getting paid. You know what I'm saying? And it would actually be more, I think, would be more of a hedge fund. Chris could probably.
And then you always have the chicken and the egg, right? Like you got the deal or you don't have the deal. So when you raise this money, say you don't have the deals at the time, are you just banking on them on the sidelines?
Here's the thing. So what I do, what I set up is called a blind pool. And so what a blind pool investment is basically, I don't have an asset already in mind. This allows, I have the strategy, I know what I'm doing, we've outlined it right. This allows me 24/7, 365 days, ever since I've set this up, all I do is think about where I can get money from. If you're accredited, I'm finding out. You're accredited, you got this, you got that. I'm constantly shopping for money. I want that to constantly be throwing money into my fund. So I'm 100% all the time trying to raise capital. And so if I don't have deals, I want the capital there, right? If I do have deals, then I'm spending the capital. So you constantly need to be raising capital. And your goal is to do the same thing. Like it allows you to continuously be raising capital. Chris does phenomenal on marketing. Robert, using those avenues, it works, man. It works. I mean, I showed him when I first showed up here. I had a guy reach out to me on LinkedIn. I've had several of them. And you start attracting big money too. You know what I'm saying? Like they're doing a portfolio. I think Chris already did it. Chris mentioned about it. They're in the process of doing a rental portfolio. Do the work, be the boots on the ground, and then turn around and then you're going to, you use the other people's money to do that and then turn around and sell that fund off, to a bigger private equity fund that's coming around shopping this stuff.
Just a couple things though, if you do set a fund up, just understand, if you don't know who the SEC is, you might want to research them. Because I will tell you this, if anyone does this, and you don't have the back-end bookkeeping and the back-end record keeping set up, Because we've gone through an SEC audit, and I don't wish that upon anyone. We made it through it because we had good records, but if you just start raising money, create your own fund, and you're kind of blindly doing it with loose records or spreadsheets on Excel, you're done. This is amazing, we've done this, we have 5 funds right now. It is simply amazing. We do a debt fund only, we don't do any ownership in ours, but if you don't take care of the back end before you start the front end,
I'll tell you what we do, we use third parties. So there's third party companies out there that facilitate the investors, they facilitate our K1, which is like a 1099 for your investors. I mean, they facilitate everything, you check them out, just like you're doing your due diligence on property management, right? You need to get your back part. The thing about a fund though, is that in that working capital, you have to pay for it. The fund pays for all this stuff, you're not paying for it out of pocket, as long as you're raising capital. So as long as you're raising capital and you get it set up, you can be paying for all your legal and marketing and different things. And so, highly recommend a third party. We're not, unless you're, I don't think we'd be here. You'd probably be at a CPA or some sort of convention if you were interested in the back office. So I definitely recommend third party. And I've got some of those I can recommend as well.
Does this blind pool have its own entity to be able to fund your Morris Capital?
Yeah. So the blind pool is technically the actual fund. Okay? And then Morris Third Capital is just the manager of that fund. I'm the manager.
Hey, Willie, you were saying something about that. I think you were saying last night that blind pool is a zero interest pool of money. So if it's
On the actual account itself, I chose to do a non-interest bearing account, and the reason why is because if you're taking somebody's money and you're making interest off of it, you technically got to be paying them back. And so if Chris did 100, you did $1 million, you did this, it gets real confusing. So the best thing to do is just be like, look, no interest, it's coming in there. It's just holding, waiting to deploy into a deal, like you said. And I'm telling you, like, when you do this, the biggest thing, the biggest shift I've seen is that you actually start attracting amazing deals and amazing capital. Like, it starts coming to you. I mean, I guess because, let's face it, I think everybody understands status, and if you're Chiefs talk to Chiefs, you know what I'm saying? Indians talk to Indians, But that's what this does. It puts you in the chief world, and now it opens up doors and it gives you vehicles. And then listen, I still have a secondary company to where I still do syndications. I still do one-offs. You know what I'm saying? Like, you just got to write your PPM that you're not dedicated to that 100% to the extent that, because say I got a big check guy comes to me, he's like, hey, look, Will, family office or something. They're like, look, we want to fund your full equity stack. They're going to want a bigger chunk, return. They're going to want a piece of the GP. They're going to want more too. Well, that don't fit in the fund. That's not, the fund's not set up for that. The fund's set up for your accredited investors that want to invest, want to diversify instead of doing, you guys already, got investors, they're doing 1 to 2 deals at a time. You can set up a fund and tell them, say, look, we're going to hedge and do 10, 20 deals at a time.
Well, yeah, I'm not a smart guy. I'm from South Louisiana. I don't know what PPM, I can't write that well. What do I do, dude? Like, I want to do this, but I don't want to pay, I don't even want to pay 11 grand. Like, I mean, you can, like, you'll write out everything and you can help us. Like, if I want to set my own up fund for mobile home parks, you do it all for us.
Yeah, so, well, what I do is I actually set up 2 things. Me and Chris talked about this, and the importance of it, we think is there. And so, I set up 2 offers, basically, where one is a group setting. I think it's 1997, and what we do is we actually go through all 80 pages of my PPM. We read it, go through it, answer questions, and then I'll actually walk you through your filing codes and all that stuff. It's all recorded, so you'll have it, how that works, and you can essentially have your fund set up by the end of that. I don't know exactly the process. It may take us 4 months, it may take us 6 months. I don't know. But, or not months, weeks, I'm sorry. Hope it don't take 6 weeks. The actual process of filing the fund, like I said, takes maybe 7 to 10 days to actually get it filed and get it back as long as everything goes well. And then, of course, if you want me to just help you one-on-one doing it too,
Yeah, could you, I mean, that would be something I think a lot of us would be interested in, because I'm not trying to go to jail with white collar crimes.
This is Chris Root writing on this PPM, can't even understand what the hell, yeah, I'd go to jail, dude.
We all would.
That's where you look at this shit, right?
Yeah.
If you, and then like I said, if you want to, I do this sort of one-on-one consulting board. It's 10 grand, but if you want to learn more, go to heywillmorris.com. And on there you can scroll down and you can learn some more about it. And then of course my contact information is there. And y'all get it as well here. I mean, it's part of company's masterminds, get one-on-one time.
So just 1997 is a group, like, you'll help us, but it won't be just one, it'll be like in a group setting?
Yeah, it's gonna be group
Like
setting.
Zoom or something, you're gonna Zoom call?
Yeah, we'll do Zoom. So, you know, the group is, and I set up a Facebook group too, where I was, just for the holdings of the recordings. You know, that way it'll all be there and go back, and of course you get, you know, support and stuff like
But you
that.
can do something like more customized, more personal.
If
I'm
you
always
want-
like, hey, Will, man, I need, just get me set up, man.
Yeah.
Get me going. I wanna do the 80-page read through.
Yeah, that,
And
yeah.
997 for that one. So, you know, I mean, it just is what it is, dude. You get one
Right.
at a
So
time.
997, you're like, we tell you what we want and
I'm
you.
gonna work with you on it, and the reason why I do that is because I don't wanna write your PPM and you come back and somebody like, you said, because where you get in trouble, like what Chris was talking about, is when you do something that's in your PPM, or you don't do something that's in your PPM, did I say it wrong? If you do something that's not in your PPM, or if you don't do something that is in your PPM. So basically, if you make an agreement, and you say, look guys, you know, here's what we're gonna do, you sign this and everything, and then you don't perform, you don't do exactly what you said, then that's when,
SEC.
that's, well, what they're gonna do is they're gonna file complaints on you, they're gonna go to SEC, they're gonna start to stink. So, you know, the best thing to do, the one-on-one, we're gonna actually go through it. I want you to understand what it's in it. Of course, I have to get it out of your head too. Like, you know, you can set these things up so many different ways, so many different structures. That's the reason why it's so mystical, right? I mean, this is a Wall Street mystical, you know, thing, and it's because there's really so many different ways that you can set this thing up. What we need to do is you need to set it up best for your business and best for your investors. You know, always keep your
So I'm
investors.
saving $30,000
Every bit of it.
by just help, if you do it one-on-one with me.
Yeah.
I'll tell you what, and just go through it.
Yeah, like I said, I was
How long
told.
would that take if you do that, like how?
So one-on-one, I mean, we should be able to get through everything in 30 days, like personally, because like I said, I really want to make sure you understand what's in there. I don't want you guys to be, you know, I didn't know this. Like you said, so what do you mean? I didn't say that. It's like, yeah, you did. You know, I want you to understand every part of it and the structure of it and how it's going to work. And then the actual, like I said, the actual filing is I think 7 to 10 days or something like that. You got 3 days for your acre and a couple days like that. So within about 45 days at most.
Question about,
Yeah.
the money that you can put in the blind pool fund. It can literally come from anybody?
No, it goes back to the 506C or 506B.
So it is one of those, okay.
Yeah, so if you have and then like I said, this gets into the structure of the fund, and again, why I want you to work one-on-one, because I don't want you taking money from somebody that you don't understand what you did, you know what I'm saying? And you need to know, like when you're talking to somebody, you need to know that an accredited investor makes $200,000 in the past 2 years on tax return. You need to know that they're $1 million in net worth minus their primary residence. You know what I'm saying? Like you need to know these things so that you're not out doing ignorant stuff. And then based off the fund and how it's structured or whatnot, depends on if you can market, you know. How you know, if you're a 506B, you can't market, but does that still mean you can't, like Chris said, does that mean I can't call somebody, I can't email somebody? You know, so I mean, you need to know what, you know, which way it's coming and how it's
There's
going.
different, you can't post on social media and ask somebody on social media on some of them, but some of them you can. I know me and Chris talked about it, like,
He sends me his email, it's like, can I send this? I'm like, change this, change that.
Yeah,
I just wanna go to jail.
yeah.
Yeah.
So you gotta be real careful about posting on social media. But no, this is good stuff. Like, this is next level stuff. Like, this is the scale.
Well, I tell you guys, and for me, the biggest thing was, because I always thought this was literally hundreds of million, 300 million institutional funds. You know, when I study this stuff, it's big time. But what really helped me is understanding, you know, that this can be my level too. I mean, it's just a $10 million fund, guys. I mean, this is pieces of sand on the beach compared to what is out there in the world of equity and hedge and stuff.
With that, I can buy $50 million worth of mobile home parks. Because I'm only having to put 20% down.
Yeah.
So you got somebody that signs their PPM, their placement agreement, right? And then their money gets deposited into the account, right? And you deploy it, I guess, wherever, and in that time that you don't have a deal, you're still responsible to pay those investors, correct?
No, I have a holding period in there, so like,
Good
you
question.
can
Well,
set
you
it
did-
up.
you did.
So you don't have to pay them unless the money's deployed.
Yeah,
Ours are different.
Ah.
So ours, the second you put your money in, within 31 days you get your first check, so you have You can set it up, I like the way he did it, but ours are different.
I think I have up to 24 months deployed, so once they come in, and of course, I'm not gonna beat people up, but I mean, if they come in and I don't really have anything, but we're not running that problem. I mean, deals are plentiful, but, you know, it's, yeah, I'm basically got 24 months.
You're saying if they come in and they want their money back because you don't have a deal, like how do you handle that objection when somebody says?
I'm not gonna beat them up, man. I'm not gonna beat them up. You know, I'm not gonna say, oh, no, you just, you know, there's some other people we were talking about that, I mean, they hold it. I mean, they hold it and they don't let you, I mean, they said, no.
You're being
You
a
know,
good human being.
technically, I do not have to give it back to them. Legally, I don't have to give it back to them. They signed it, they agreed to it. You know, everybody knows that a contract is a contract, right? Me and Chris to agree that he holds me up for 36 hours. And if he only pays me $5,000, well, we gotta do it, you know, it's a contract. We both agreed on it, so if he drops me. So, as silly as that sounds, it's true, and that's a simple form of this. It's just a lot of agreements in a certain kind of structure. So to answer your question, I build holding periods into mine, to where you can constantly be raising capital, and you know, they understand by signing that you may not have a deal at the current time, you know, that it's available. So
And then you haven't had any problems with them getting upset, like?
sometimes, I mean, like if it takes 6 or 9 months, you start getting a phone call, hey,
Right.
you know, my money can be working here, be working there. It's okay, I totally understand, I get it. You can put it in a savings account, be making 0.0001% right now, or you can hold it with me for another 3 months. 3 months, we've got one in the works, and we'll allocate it. We'll be at 10% cash on cash very soon. Okay, great. You know what I'm saying? It just, but honestly, this is why I gotta say this to you. I like working with accredited investors. I don't want your last dollar. I don't want your last $50,000. You know, if you're those kind of people that it's their last $50,000 or whatever, or they're taking out of the 401ks and they've got 300,000 and they're going to give you 100, they're going to call you. They're going to want to know what's going on, how's it happening, you know, where's our returns, da da da
They're the
da.
ones gonna beat you up.
Yeah, I like accredited investors where I can let them know that, hey, look, you know, they can write you a $200,000 or $300,000, sometimes $1 million check and not, you know, they go on about their business. They understand that their money's working for them. They understand the process. I personally would start, 2 reasons I would start with 506Cs is because of that reason. The investors are a lot easier to deal with, and 2 is so you can market, because this is going to attract you. I mean, this is going to blow you. This is going to take you from, you know, average Joe wholesaler to wholesaler with a hedge fund. You know what I'm saying? It's going to take you from holdings company with a hedge fund. You know what I'm saying? Like this is going to blow it up. Chris going from 8 to 80 parts. You know this is how you do it. This is how the big boys play.
So we went pretty deep on this with you last night and told you what we're trying to do. You're like, start with trying to raise $1 million or $2 million. So should we go on that capital raising crusade and then come to you and say, hey man, we got $1 million committed, let's set it all up, or do it the opposite?
Yeah, I mean you definitely can. I think, but my experience, I actually did it that way. It's kind of more the syndication model, really. If you're raising capital and then you know kind of come. But what I had with that is that I like closing. So when I got to the point, I was like, you know, got them right there, and they're like, yeah, I'm ready to go, I'm ready to go. Now I can say, I'm going to send you an email with my wiring instructions. Whereas you're like, well, hold that thought. You know, we're going to set up a fund, and then we'll come back and get your money. By that time, they're off on something else. They already spent their money half the time. So I mean, when they're there, they're motivated, they're ready to go. Let's get it done. You know, ink the deal.
So how much like credibility do you have to like even with these 5?
That's a good question. I didn't touch on that. That's a good question. So what I've done on my first, because your first fund's gonna be tough. I'm not gonna lie. They're gonna look at you and say, well, you're a first time fund manager, whatever. What's your experience? What's your track record? And so what I did with that is I masked that with great deals. I brought them good deals, good opportunities that you guys can all source as wholesalers. And I'd be like, look, you know, here's the deal. Here's the beautiful deal. Best thing you've ever seen. Well, they kind of forget about who's bringing it to them, the carrier, and they look more into the deal. And so I leverage really good deals and great opportunities and good returns. Do you have a question?
Yeah, let's talk about the fees for a second. I know we're about to eat lunch. 1%, and then like a salary, for lack of a better term. Is that realistic?
Yeah, that's written in there. And it's actually very small in comparison to our fund setup. Like there's one mobile home fund that I've been studying. Guys killing him. Like I think
When can you take those fees?
Huh?
When can you take those fees?
The acquisition is based off the acquisition, total acquisition cost. So $10 million example will get you $30 million in total acquisition. You do that as you acquire. Just like when you buy something, you can take an acquisition fee. That's
So
what it
as
stands
that
for.
deal closes, you get paid.
When it closes, you get a check.
And how about the working capital?
Well, let me finish the asset management. Asset management is every year. That's your pay for managing the assets.
Okay.
And then the 1%, what they call disposition or refile, like I've got a 2% refile on mine, so.
On the exit. Yeah.
I'm sorry.
No, I'm just listening, I'm taking.
Well, I got 8 right now, I'm probably gonna buy another 4 or 5 here by the end of the year. Could I package that up, start them off the fund and sell it back to the fund?
Absolutely.
And then
I
manage
told
the
you,
fund?
that's what I would actually do that first. Because you're basically become your own, your own client. You're both, you're a double, what
I'm
they
making on
call.
both sides, I sell it, make a premium, and
What
I
they call
manage
it,
it.
you're an agent and you represent buyer and seller, what they call
Yeah,
that.
conflict of interest, I like that.
So you're like a double close or whatever, double agent. And, so yeah, since he's already got it, basically he can start a fund with the purpose of acquiring all his assets. He acts as like a hedge fund, but he's also the client. And
Is
so,
that legal, do I go to jail?
yeah, you can do that. So you raise your capital, do all stuff, and turn around, and as long as you state it, as long as they understand what you're doing, they understand that, look, I already own these parts, we've already managed them, we're already got them profitable, we're already here. And so what we're doing, our simple plan is to raise capital, we're gonna turn around, we're gonna package these up, and we're gonna put them on, and then it'll be in a hedge fund, or an equity fund, whatever you want, and it's just gonna perform. And then you can take that debt, or the profits, and the cash flow, because I would still, you still have ownership in it, and you can take that and roll it into bigger deals and more deals.
Wow. Yeah, this is awesome. Who thinks this is freaking next level stuff?
Way above my head.
Yeah. This is
Don't like I said, that's my big thing too, because I thought the same thing. Like, I don't want to oversimplify it, but at the same time, I don't want you to continue down that road, that this is a big time, Wall Street type of deal.